On May 16, 2025, Moody's Ratings made a historic move by downgrading the United States long-term credit rating from its highest AAA status to AA1. This decision echoed through financial markets, government offices, and households alike, as it marked the first time in history that all three major credit rating agencies, Moody's, Fitch, and S&P, have rated U.S. sovereign debt below the top tier. The downgrade reflects deep and persistent concerns about America's fiscal health, political gridlock, and the mounting burden of debt and interest payments. Over the past decade, the United States has seen its government debt and interest payments grow at a pace that outstrips those of other, highly rated countries. The federal debt burden is projected to reach approximately 134% of GDP by 2035, up from 98% in 2024. This means that for every dollar the U.S. economy produces, the government owes more than $1 in debt, a level that is unprecedented in modern American history. This rising debt is not just a number on a page, it represents real money that must be borrowed, serviced, and eventually repaid. As debt accumulates, so too do the interest payments required to service that debt. These payments now consume a significant and growing portion of the federal budget, leaving less room for other priorities such as infrastructure, education, and defense. The United States has run large annual deficits for years, spending more than it brings in through taxes and other revenues. Successive administrations and Congresses have failed to agree on effective measures to reverse this trend. The result is a pattern of borrowing to cover the gap, which only adds to the overall debt burden. Deficits are not inherently bad. Many governments run them to finance investments or respond to crises, but persistent large deficits can signal underlying structural problems. In the US, these deficits are driven by a combination of rising entitlement spending, relatively low revenue generation, and a lack of political consensus on how to address the imbalance. One of the key drivers of the downgrade was the increase in interest payments on the federal debt. As the total debt rises and interest rates remain elevated, the cost of servicing the debt climbs higher. At the same time, entitlement programs such as Social Security, Medicare, and Medicaid continue to grow as the population ages and healthcare costs rise. These mandatory spending programs are politically sensitive and difficult to reform, but they represent a significant and growing share of the federal budget. Without changes to these programs or significant increases in revenue, the fiscal outlook remains challenging. Moody's also pointed to decades of political dysfunction and an inability to implement meaningful, long-term reductions in mandatory spending or deficits. The U.S. political system has become increasingly polarized, making it difficult to reach consensus on major fiscal reforms. This gridlock is compounded by policy uncertainty, including evolving trade priorities and ongoing debates over tax cuts and spending reductions. Investors and rating agencies look for stability and predictability in fiscal policy, and the current environment has provided little of either. President Donald Trump, having returned to office in January 2025, has made balancing the federal budget a central goal of his administration. His approach includes revenue-enhancing tariffs and proposed spending reductions. However, there is widespread skepticism among economists and analysts that current proposals will achieve significant deficit reduction, especially given the scale of the challenge. The administration has faced legislative challenges as well. The downgrade coincided with a setback for Trump's tax reform proposal, as hardline Republicans in Congress blocked the legislation, demanding deeper spending cuts. This episode highlights the difficulty of enacting major fiscal reforms in a divided political landscape. The downgrade by Moody's follows similar moves by Fitch in August 2023 and S&P back in 2011. Until now, Moody's had maintained a top rating for the US, even as it warned in late 2023 that the outlook was negative due to fiscal concerns. With this downgrade, all three major rating agencies now agree that US sovereign debt no longer merits the highest possible rating. The downgrade comes at a time of ongoing economic uncertainty. The US economy remains the largest and most dynamic in the world, but it faces headwinds from inflation, rising interest rates, and global trade tensions. The federal government's fiscal challenges add another layer of complexity, as policymakers must balance the need for economic growth with the imperative to restore fiscal discipline. A lower credit rating typically signals higher risk for investors. As a result, the US government may face increased borrowing costs, as investors demand higher yields to compensate for the perceived risk. Higher borrowing costs can further strain federal finances, creating a vicious cycle of debt and interest payments. These costs can also ripple through the broader economy. When the government pays more to borrow, it can lead to higher interest rates for businesses and consumers, affecting everything from mortgages to car loans to credit cards. Despite the downgrade, the United States retains exceptional credit strengths, including the size and resilience of its economy, the global reserve status of the dollar, and an independent Federal Reserve. These factors provide a strong foundation for investor confidence, even in the face of fiscal challenges. However, the downgrade serves as a warning sign. It signals to investors that the US is not immune to the consequences of fiscal mismanagement. Over time, repeated downgrades or further erosion of fiscal discipline could undermine confidence in US debt and the dollar. The immediate market reaction to the downgrade was mixed. Some investors shrugged off the news, citing the US's unique position in the global financial system. Others expressed concern that the downgrade could unsettle financial markets and add to the financial burden for Americans, especially amid ongoing inflation and tariff pressures. In the longer term, the downgrade could have broader implications for global markets. US Treasury securities are considered the safest and most liquid assets in the world, serving as a benchmark for other investments. Any erosion of confidence in US debt could have far-reaching effects on global financial stability. Moody's changed its outlook on the US from negative to stable, indicating it does not foresee another downgrade in the near term. However, the agency expects federal deficits to grow from 6.4% of GDP in 2024 to nearly 9% by 2035, driven by rising interest payments, entitlement spending, and modest revenue growth. This outlook underscores the need for credible, long-term fiscal reforms. Policymakers face difficult choices: raising taxes, cutting spending, reforming entitlement programs, or some combination of these measures. Each option carries political risks and economic trade-offs. Addressing the nation's fiscal challenges will require strong political leadership and a willingness to make tough decisions. The current environment of polarization and gridlock makes this task even more daunting. However, history shows that the US has overcome fiscal challenges before, often in times of crisis. Building consensus around a sustainable fiscal path will not be easy, but it is essential for restoring confidence in America's financial future. The US dollar remains the world's reserve currency, and US Treasury securities are central to the global financial system. This gives the US unique advantages, including the ability to borrow at relatively low cost and to absorb shocks that might destabilize other countries. However, these advantages are not unlimited. Persistent fiscal imbalances and repeated downgrades could, over time, erode the special status of US debt and the dollar. Other countries and investors may begin to diversify away from US assets, seeking alternatives that offer greater stability or higher returns. Moody's downgrade of the US credit rating is more than a technical adjustment. It is a wake-up call for policymakers, investors, and citizens alike. It reflects deepening concern over America's fiscal trajectory persistent political gridlock, and the growing burden of debt and interest payments. While the United States retains significant economic strengths, the loss of its last AAA rating underscores the urgent need for credible long-term fiscal reforms. The path forward will not be easy, but with strong leadership and a willingness to confront difficult choices, the US can restore its fiscal health and maintain its position as a global economic leader. As the world watches America's next move, the recent credit rating downgrade serves as a crucial wake-up call. The nation stands at a crossroads. Continued inaction could deepen fiscal challenges, while decisive leadership and meaningful reform can restore confidence and secure a brighter economic future. Now is the time for citizens, policymakers, and business leaders to demand responsible fiscal solutions. Stay informed, get involved, and urge your representatives to prioritize sustainable policies. Together we can help shape a stronger, more resilient future for the United States and the global economy.